What's going on, guys? It's Terrence Davis coming at you with a quick video on the Fibonacci retracement levels, guys. This is going to be a very important video. If you're new to studying and using the Fibonacci, I'm pretty sure that you're going to quickly realize that this is where a lot of people are missing in their trading journey, guys. Most people jump right into their strategies, right into their indicators, filling their charts up with all types of bogus before they even understand the tendencies of the market, before they even understand market patterns and market behavior. And that's another reason that adds on to why over 90% of people fail, is because they're being overloaded with all this stuff in the beginning before even understanding the simplicity of the market and understanding things like this about the retracement levels, about pivot points and things of that nature. Just price action and price behavior, okay, guys? So today we're going to jump right into it, guys. First and foremost, we always want to go to our day chart and get a feel, an idea on what the market's doing. So as we look at this market, we can see that it was in a large downward trend, all right? But just recently, let's say this is probably about a month or a little bit more, price has been going gradually up, slightly up. So we can say that price is in a nice little small upward trend. We can barely say that. But we want to place our support and resistance lines, guys, because these are these are very important. If we ever come across these lines on our smaller charts, we should keep a heads up of what the market had tended to do, previously. So these are very important lines. We can draw a nice resistance line right there because we can see the market kind of like never really went too much above that, kind of bounced off, went down again up here, didn't really go past it, bounced down right here, didn't go past it, bounced down, and broke up through right here, but came right back down. But the fact that it broke up is showing us, it's verifying that this is most likely going to continue in an upward trend, and that was just a little small retracement. We also can put a nice support line right there because we can see, price rose from right here, price bounced off and rose right there, price bounced off, rose there, and it didn't quite make it here. It actually set a higher low right there. That's another great verification that price is going to actually start a nice upward trend. So with that being said, guys, we want to only look to buy the market. We're only even worried about placing in sales. We're only looking to buy the market. So we're going to go over to our 4-hour chart. You can see we have our nice support and resistance line right here displayed on our 4-hour chart. So we would have kept that in mind. If we actually placed any buys in here and it hit right here, this would have been a great indication to get out, as well as right here. All right, coming over here, it's not really good buys unless you would have gotten in, somewhere down here. All right, so let's jump right into it, guys. We're gonna pull out our Fibonacci right here, and we're gonna jump into showing you how to identify, first and foremost, a trend. So we already saw that price was basically generally in an upward trend. But another way to verify that, one second, bring this down a little bit. I mean, it doesn't have to be perfect, but you want to make it as perfect as you can. Actually, I can't move it more Fibonacci, but we can see that we had a low right here, and there's a high. And this low was actually higher than this low. Right? Or arguably, this could have been the second low. So what you're looking for is a low that's higher than the first low and a high that's higher than the first high. That's how you identify if it's trending either upwards or downwards. So if you have two lows, one has to be lower and the other high has to be lower if it's a downward trend, and vice versa. There's a low and there's a higher low, there's a high and there's a higher high. So that's showing us a nice upward trend. So if we would have verified that, we would have went over here, we got our Fibonacci retracement indicator, we would have went from this low right there all the way up to that high right there. That's how we would have done that. And we will go here and we'll insert what we call magical. We call this the magical box. Alright, because price tends to do the same thing more often than not. And this isn't 100%, but we're going to show you today what the price tends to do when it comes and plays between this 50 and 61%. Let's say the market was right here. We verified that this is most likely going to be an upward trend. We saw that we had a higher high here and a higher low, so we drew and we just waited out. Now, since we traded on a 4-hour chart, guys, we're going to need some patience. Okay, we're going to need some patience in this. So it's going to take maybe a day or two before we want to place our trades. However, it's going to pay off. You're going to cash out on hundreds of pips. You're going to make thousands of dollars if you do this correctly. All right. So I do see some people doing it on the smaller charts. Don't get me wrong. You can do it on any chart you want. However, the larger the chart, the more money you can make. All right. And I know that everybody who's watching this video is here to obviously make money. So let's get right into it, guys. We would have waited for this market. We want to wait for this market to drop in this zone right there. And we can see when it drops in this zone, it may come below here, and that's fine. But we want to wait until the candle that comes out up in the direction of the trend, and that's when we want to buy. Okay, so let's say we saw this candle right here break up out. We would have bought right there, and we would have rolled that up all the way to right here. We could have taken some small profit, but we're trading on a larger scale. This candle right here would have dropped back into the box. That's absolutely fine. Our trade, may have went to a slight negative right here, but guess what? We're going to place a stop loss right there. There's no need to panic, guys, because as long as this does not dip below this, we're perfectly fine. And look at that, guys. The next one came back up. We could have taken that profit and we could have waited to re-enter. We could have kept it open, and boom, we would have rolled this from 1.1, roughly 1.101 all the way up to 1.17, guys. Would have caught a ton of pips, and that's the type of trades I like to get in personally, guys. So we will always want to remember, we want to wait until the market comes up out of that box between 50 and 60% to enter in our trade. Now we could have done it again. Let's say we got out here. Let's say we didn't capitalize off all these pips, and we just want to see the next retracement level. So we're going to go from this low here to that high that I just set up there. Alright, and we would have once again went and drew our magical box right there. Right between that 50 and that 60. That's where you want to place that. So we'll be studying the market. It dropped right in between that. So we would have drawn, say, okay, the market's dip below it. That's fine. We only looking to buy, so we're not worried. As long as it doesn't come past this 100%, that's when the trend most likely is over. We're perfectly fine. We're watching it. Over the course of a couple of days, it comes back into this zone. We may be looking to enter in buys if it breaks above this. However, it doesn't. It drops below it again. So we're not looking, but that's what it comes right back up to it to close out the week on 9/11 on a Friday, guys. So that's what the market's closed. But I predict that since this is an upward trend, it's going to break up out of this, and this will be a great buy to enter in going into mid-September 2015, guys. We're going to trace back just to show you guys if this works. In general, with anything, we're going to try to find a downward trend really quick. Actually, we can do this one right here if we haven't already. I think we have done this one. So we're going to try to identify a downward trend. When the price was on a large downward trend, we could do the same thing. Let's just try to find a high and a low really quick. Alright, let's see right here, right there, alright? So this is when price is on the downward trend. So we're gonna go to this low. This was the lowest low, and that was the highest high. Alright, we're looking to sell. I should say this is back when price was dropping tremendously. Alright, same thing, guys. Insert shapes, rectangle, right between that 50 and that 60. So we're gonna be looking right there. Right. So we saw price come up. This is the retracement, and we want to wait until it breaks back below this 60% and enter in a sale right there and cash out on that right there. Load it all the way down. Same stuff, guys. It's the same concept. You can scroll back. This is an ugly chart because it's been going down so much. But you can do it again from this high right here. This low, just for educational purposes. You go ahead, enter in, put it right on your 50%, between 50 and 60, right there. Alright, so we would have let price come up, play with it, drop back down. Came back up, played with it, drop back down, enter here, caught all that. Alright, because price is in a downward trend. So this is the retracement. We don't want to sell here. That's what a lot of people get in trouble, is because they're not patient, they sell at the wrong time, and these little retracements is what kills people, blows people's account. Because they might be on a 30-minute chart, looking to sell at the absolute wrong time, right? They could be looking to sell right here, entering the sell, look, for hours, just going up out of your favor. For hours, on a 15-minute chart, you're getting killed. You see what I mean? You're getting murdered because you're not being patient. You're not looking at the overall picture. You're not taking those retracements into credibility, to accountability. So with that being said, that's why we trade off the 4 hour, because we can see the general direction. And since we see that, then you can do some smaller scalps off of the 15-minute. Alright, but look at that. Came up below there, dropped, and entered in the sell. When it dropped out right there, make sure you're placing trades that that won't blow your account, because it may retrace, come back up in this blue. That's a lot of pips if you're using large lots. But if you're able to hold your trade off, it will pay off. Alright guys, so this is the Fibonacci retracement levels. You can use this on any chart you want. I hope this helped you a lot with your trading. Like I said, we should start here, understanding this before we add all these other indicators and stuff. Guys, I hope you enjoyed this video, and I hope you have a tremendous success in your trading. It's Terrence Davis signing out. You guys, make it a great day. Give me a thumbs up if you enjoyed this video. Comment, like, subscribe. Everything will be greatly appreciated. Terrence Davis signing out.